I own part of Amazon. Sounds wild, right? But it's 100% true, and you can too. No, I didn't buy a warehouse or start working for Jeff Bezos. I bought a share of Amazon stock, and that one share makes me a part owner of one of the biggest companies in the world. In this video, I'm going to explain what a stock actually is, how you can buy your first share, and the difference between investing and trading, so you can figure out which path makes sense for you. So, what is a stock? A stock is a tiny piece of a company. When a company wants to raise money, they can go public and sell shares to investors, like you and me. When you buy one of those shares, you're literally buying ownership. Even if it's just one share, you become a shareholder. So if you own a share of Apple, Nike or Netflix, you actually own a piece of that business. Let's break this down with an example. Imagine a pizza. That pizza is the whole company. If the company splits it into 100 slices and you buy one slice, you now own 1% of the company. Pretty cool, right? How do you buy stocks? Well, you don't need to walk into a bank or call someone on Wall Street. These days, you just need a smartphone. All you have to do is download a brokerage app. Think of it like Amazon, but for stocks. Some beginner-friendly apps include Robinhood, Charles Schwab, Webull. I added their links in the description below. Once you sign up and connect your bank, you deposit money, search for the stock symbol like AAPL for Apple, and click buy. Boom! You now own a piece of that company. Let's say Apple stock is trading at $200. You can buy one share or even a fractional share if you don't have $200 to invest. Yes, some apps let you invest with as little as $5. Why do people buy stocks? Here's the main reason. People want their money to grow. When you keep your money in a savings account, it earns tiny interest. When you put it in the stock market, that money has the potential to grow faster if you pick the right companies. Let's say you bought one share of Amazon at $100. If it goes up to $150, you just made $50 profit. But here's the catch. If Amazon goes down to $80, you lose $20 in value. So there is potential for profit, but also risk. Investor versus trader. What's the difference? Now here's where it gets interesting. Not everyone buys stocks the same way. There are investors and there are traders, and they play the game very differently. Investors are in it for the long haul. They buy stocks in companies they believe in, then hold them for years. Think Warren Buffett. He's known for buying companies and sitting on them for decades. Long-term investors often look for strong companies with steady growth. Stocks that pay dividends, which are like bonus cash payments, a slow and steady path to wealth. On the other hand, traders are trying to make money in the short term. They buy a stock in the morning and sell it by the afternoon, or hold it for a few days or weeks. Traders often look at price charts, market trends, quick ups and downs they can profit from. Trading can be exciting, but it's also riskier and takes a lot more time, knowledge, and discipline. So ask yourself, are you looking to grow your wealth slowly over time? You might be an investor. Want to be more hands-on, active, and take on risk for quicker gains? That's a trader mindset. There's no right or wrong, just different styles. Before you start, whether you decide to be a trader or an investor, here are a few golden rules. Never invest money you can't afford to lose. Start small, especially when you're learning. Don't buy a stock just because it's trending. Do your research. Be patient. Wealth takes time. Thanks for watching. If you like this video, check out our other videos and don't forget to like and subscribe.